Right. Okay. Okay. Let's start. We have small cap versus large cap today in the beginning. Just switch to the computer. Just switch to the computer. Yeah.
Section 1 will serve as our introduction to this topic. Cap, or market capitalization, refers to the total market value of a company's outstanding shares. The way that capitalization is calculated is by multiplying the total number of shares available by the company's total current stock price. As you see on the slide, if Company X has 30 million shares and those shares are valued at $100, then the company's market cap is $3 billion. Due to the fact that the overall global economy is growing and changing, it only makes sense the definitions of small and large cap assets have also changed. For example, in the 1980s, a company with a market cap of $1 billion would have been considered a large cap. In today's economy, that same stock would only be considered a small cap. It is likely that these definitions will continue to change over time. Being a mega cap today might only warrant you a large cap status in the future. Due to diversity in the marketplace and constantly changing economic conditions, it is likely that any given stock will eventually realize a loss of value. As we will show in this presentation, small caps have a higher affinity to have greater returns but also greater risk. Large caps are less likely to see great swings in value but should produce a rather steady return. Of course, this is not always the case, as we saw with Enron, which was a large cap company back in 2000. At the time, Enron was a $101 billion company and was rated 7th on the Fortune 500 list, with a stock value of $90 per share. However, just 1 year later, their market cap was cut in half due to dramatic decrease in the value of the stock. By the end of 2001, Enron declared bankruptcy, causing most of its workers to be displaced. Thus, it is never a guarantee that any one stock will perform at a certain level, and diversification can save you as an investor from losing a large portion of your portfolio if one of your companies fails. In session 2, we will talk and discuss more of the theory behind small caps to increase your annual returns on your portfolio. Small cap definition. Small caps now encompass corporations whose market capitalization ranges from $300 million to $2 billion. These assets can be used in your portfolio to increase portfolio return and, if properly done, can do so without adding a significant amount of risk. Currently, the marketplace is comprised of approximately 35% small caps and only 15% large caps. In order to visualize how small caps perform, we studied 5 small cap assets and their performance over the past 5 years. The graph on the right shows the rate of return over the standard deviation, or risk, of those assets as a percentage. As you can see, the size of the capitalization of the asset did not necessarily decrease its risk. CTC Media, who had the highest capitalization, still had the second highest risk. The flip side of that coin is also true. Navios Maritime Aquis Corporation, who had the smallest of the caps, had the highest risk and the lowest return. Therefore, we can draw from this graph that small caps as individual stocks are quite risky and may not yield a positive return over a 5-year period. Small cap funds. The funds are a conglomerate of stocks usually purchased by a company that sells shares in their fund. In this case, we examined 4 small cap funds: T. Rowe Price, Neuberger Berman, Royce, and Vanguard. As you see in the chart on the right, we again graphed portfolio versus standard deviation. This time we only used data from the previous 3 years. You can see in the figures that 3 of the 4 funds linger around 18% risk, with a return ranging from 9 to 17%. The one outlier in this case was Vanguard with a return of 22%, but also an increased risk of approximately 22%. Therefore, if an investor feels like the risk is worth the reward, they might put more money in the Vanguard small cap fund than, say, a Neuberger Berman fund, which had the lowest return but also the lowest risk of the four funds. It is recommended then that investors utilize these high-risk, high-return stocks to help improve the return for the overall portfolio. If an investor wants to reduce their risk of these types of small-cap stocks, it is further recommended that they utilize small-cap funds instead of individual stocks. In Section 3, we will discuss large caps and strategies investors utilize to decrease risk. Using large cap stocks as long-term core can give investors relatively reliable growth over the long term with significantly higher returns than near risk-free assets like bonds. In this example, we used 5 companies and we calculated the return and standard deviation as percentages over the last 5 years. The majority of these companies have steady rate of return over the past 5 years with little risk. Apple is an outlier which experienced very heavy swings due to a variety of factors, including economic conditions and change in leadership. In this case, all stocks except for PetroChina are on the efficient frontier. For examples of large cap funds, we chose 4 funds and calculated the return and standard deviation over the last 3 years. Through diversification, we found within the funds, even when using primarily large cap stocks, a noticeable increase in return is given for about the same amount of risk when compared to individual stocks from the previous slide. In this case, BNY Mellon US Stock Index and Vanguard Extended Market Index are on the efficient frontier. As demonstrated in the preceding example charts, large cap funds tend to be around the same risk level as top large cap individual stocks. However, they are able to incorporate riskier assets with higher returns along with less risky assets to maintain an acceptable risk level with a superior return. When looking at the efficient frontier from the earlier slides, note that the asset with the lowest risk will always be on the efficient frontier if it is the only asset at the risk level. In other words, an asset can only be dominated by an asset with equal or lesser risk. While risk is always a factor, it is less dominant when dealing with large cap assets due to the relatively low level of risk. Additionally, since large cap assets are usually used as long-term core, the length of time allows the risk to dampen out over time. To allow the return to play a larger role in determining which assets to invest in, one can use the return-risk ratio. For individual assets, the ratio shows a very different story than one would get when looking strictly at risk alone. However, the ratio should probably not be used in a vacuum. Although Apple comes out on top in the ratio method, the excessive amount of risk shown may scare off some investors. For funds, the picture also changes when using ratio method. Risk alone would lead one towards BNY Mellon US Stock Index or American Funds New Perspective. The ratio shows us that a better choice would be between BNY Mellon and the Vanguard Extended Market Index. Notice how this aligns perfectly with the efficient frontier of the funds from earlier, but the ratio can help us determine which efficient assets are preferable to other efficient assets. When using options with large cap assets, consider that the relatively low level of risk indicates that the value of the asset will not change rapidly. Therefore, the high payoff potential of straight call holds is wasted due to the low likelihood of major swing in the asset price. It would be better to aim for strategies that capitalize on small changes in price, like the butterfly spread. In Section 4, we will discuss how utilizing diversification can increase portfolio return and reduce risk to the investor. To show a comparison, we use the S&P 500 index, which monitors large cap funds, and the S&P 600 index, which is comprised of small cap funds. The table above shows the average rates of return and standard deviations from the past 10 years. Upon examining the table, we notice that the small caps exhibit a greater rate of return, but also a greater deviation, as expected. Using the two index measures in calculating expected return and standard deviation for many different weight options, this graph depicts the results. Three correlation coefficients were used for calculation: negative 0.5, 0, and 0.5. The results show that using variations of assets that are negatively correlated results in lower risk as measured by standard deviation. Using the table and graph shown, we see the rates of return and standard deviations when we allow shorting of the chosen funds. Here we see a greater range of expected return, but with higher standard deviations as well. It can also be seen from this graph that if we allow shorting, positively correlated assets yield lower risk. This gives the investor another tool when determining the amount of risk he or she is willing to take. By using a mix of small and large cap funds, the investor or corporation can achieve the steady portfolio growth of large caps while having the potential for higher returns observed by the small cap options. When determining how heavily to invest in one market cap, there are several factors that must be considered. The general trend of the market over long periods is positive growth. However, in shorter terms, it tends to fluctuate, so the amount of time the money or assets will be invested is very important consideration when determining how to invest in the small and large cap funds. Our goal is to invest in firms that we feel will perform well and make us money by investing in them. Some of the indicators about the strength of a stock or company would be sales, profits, value of assets, and of course, market capitalization. This chart shows the top 10 companies by market capitalization and how they rank in some other categories. We see great correlation between the market cap and profits, but much less in sales and very little between market cap and assets. Some financial experts would question whether market capitalization as an investment strategy is a wise decision. For example, a large cap could drop drastically and move into the small cap category, but it may not be able to grow as many small caps do if it has already dropped significantly. Or if a small company rapidly rises in stock price due to some brief fad or anomaly, moving it from small cap to large cap, it is very likely still a rather volatile fund. This could lead some investors to choose not to use market capitalization in their fund selection process. In Section 5, we'll discuss our results and our conclusions. As we have shown in this presentation, small caps are generally more likely to have a greater return, but only at the cost of higher risk. Large cap stocks are likely to have a medium return, but also have a medium level of risk. Also, as we have shown, diversification can be a valuable tool for any investor who wants to reduce overall portfolio risk without necessarily losing out on potential returns. As an investor, it is important to find the right balance for your particular goals. It is a recommendation of this team that investors therefore utilize large cap stocks or funds as long-term core for a portfolio and offset those with small cap stocks or funds that can help raise the portfolio's annual rate of return. We have also shown that looking for assets that are negatively correlated can further reduce the overall risk of your portfolio. Utilizing shorting and option strategies can further increase returns but may introduce additional risk to your portfolio. Thank you for your attention. At this time, if there are any questions, you can raise them in class. Thank you.
In this presentation, we will be discussing benefits of assessing risk in business, future state risk usage, measures of risk management, and we will finish with a slide summarizing the 5 measures of risk management and sources used in this presentation. Some of the benefits of assessing risk in business include an increased transparency of risk, internal and external communication, hedging decisions in business to reduce a company's losses due to fluctuations in the market, capital allocations or budget planning, and performance evaluation. Here is a list of usages for future state risks. Some of these include evaluate the risk against a planned budget, improving risk management, comparing market risk with business risk, and managing risk of anticipated transactions. Next, we will discuss the measures of risk management. These measures include volatility, correlated volatility, value at risk, earnings at risk, and cash flow at risk. In financial engineering, volatility measures an asset's risk to price variation or fluctuation over a given period of time. The volatility of an asset is an important risk analysis tool to an investor. There are 3 measures of volatility: actual current volatility, actual historical volatility, and implied or future volatility. Assets with high volatility can be viewed as either risky or advantageous. For an elderly investor or for a firm wanting to develop a portfolio with a steady rate of return, assets with high volatility are risky due to unpredictable movements in price which could result in extreme losses. However, for a young or aggressive investor, assets with high volatility present the opportunity for extreme gains. On the other hand, an asset or stock with low volatility tends to have smaller random gains or losses over time. Compared to high volatility, the magnitude of change is much smaller and more consistent. Assets with low volatility are relatively stable and are typically less risky than high volatility assets. To calculate historical volatility, we will start by calculating the actual current volatility, or the risk of day-to-day price change of an asset in a market. The equation for the actual current volatility is as shown. Here, the volatility R sub t is measured by taking the natural log of the ratio of a stock's current price, S sub t, to the previous day's stock price, S sub t minus 1. This equation results in a value which is similar to the daily percentage price change of an asset. Next, we can calculate the average day-to-day volatility over a given period of time. The equation is as shown. Here, the average volatility, R sub m, is simply calculated as the sum of the day-to-day volatility, R sub t, divided by the number of days, n, in a given time period. Finally, with the 2 previous equations defined, it is possible to calculate the historical volatility of an asset as shown. Here, the historical volatility, HV, is estimated as the average variance from the standard deviation. This gives a historical volatility over a n-day historical period of time. These values can be used to calculate an annual volatility percentage by multiplying by the square root of the number of trading days in a year, typically 252. Implied volatility attempts to predict the market's expectation of an asset's future price moves. Although the industry currently does not have a standard method of calculation for an asset's future price, there are some widely used methods such as autoregressive conditional heteroscedasticity arch and the exponential generalized arch models. These models and normalized statistical distributions created by Monte Carlo simulations attempt to predict the future volatility of an asset in the market. An investor can use both historical and implied volatility to evaluate how an asset is currently being valued in the market. For example, if we plot the 30-day historical volatility of an asset with the implied volatility, we can determine if an asset is over or undervalued. In this example shown, since the implied volatility is higher than the historical volatility, it indicates the asset is overvalued, and it is a good time to sell before the price declines further. Another important metric of an asset's volatility is its correlated volatility. The correlated volatility, beta, measures how an asset will behave in relation to the volatility of a benchmark asset, such as the S&P 500. The correlated volatility of an asset is simply calculated as shown. Here, the correlated volatility is calculated as the ratio of the covariance of an asset and the benchmark to the variance of the benchmark. The value of the correlated volatility indicates to the investor how the asset behaves in relation to the overall market. The table shown summarizes how the asset behaves based on its beta value. This can be a useful metric for an investor in determining which mix of assets should be used in a portfolio to reduce risk due to overall market fluctuations. Here is an example of a stock with 3 graphs shown. From the 30-day volatility, we can determine that the stock is highly volatile. From the 30-day correlated volatility, we can see that the majority of the time the beta is greater than 1. From the previous table, we can determine that this indicates that the asset generally follows the benchmark, but with more movement. Finally, we can see in the last graph that the stock price movements do indeed follow the market trend with overshoot. As the S&P 500's price drops, the stock's price drops more and vice versa. The value at risk for an investor or company is based on statistical methods. It measures and quantifies the amount of financial risk an asset presents over a given period of time. This method accounts for time and uses a normalized distribution to determine the losses or gains based on a given confidence level. There are 3 methods to calculate the value at risk: historical, variance covariance, and Monte Carlo simulation. The historical method for determining the value at risk of an asset is found simply by creating a distribution of daily returns over a given period of time. In the example shown, about 1400% daily return values were used to create the distribution plot shown. The chart tells us that at 95% confidence level, we can say that the worst daily loss will not exceed 4%. The second method for calculating the value at risk is variance covariance method. This method uses the same data from the historical calculation, but assumes that the returns are normally distributed as shown by the blue line. To create the normal distribution, we also need an estimated future rate of return and standard deviation. With all of this known, we can determine the rate of return from the normal distribution line simply by multiplying the standard deviation by either negative 1.65 or negative 2.33 for 95 or 99% confidence respectively. In the example shown, we can see that this method produces values similar to the historical method. In general, the method can be used to determine the amount of money at risk by multiplying the previous number, the rate of return percentage, times the mark-to-market value of the portfolio. The general equation is given as shown. Finally, the value at risk can be determined via a Monte Carlo simulation. However, this involves complex models such as the ARCH or EG-ARCH models to determine the future asset or stock price. In the example shown, 100 cases were generated. From the results, we can see that the worst case percentage value at risk is estimated to be between 15 and 20%, much greater than the other 2 methods. Cash flow at risk is defined as the maximum shortfall of net cash generated relative to a specific target for a specified reporting period and confidence level. The shortfall is determined to be the difference between the budgeted future cash flow and the determined confidence level cash flow. The majority of companies will use a confidence level of 95% when assessing cash flow at risk. Earnings at risk is defined as the maximum shortfall of earnings relative to a specific target for a specified reporting period and confidence level. Earnings at risk and value at risk are closely related since value at risk is based off a company's rate of return. Again, similarly to cash flow at risk, earnings at risk can be calculated for extended periods of time such as months, quarters, or years. The steps to assessing earnings at risk and cash flow at risk are very similar. The first of 5 steps is to identify what measurement you would like to predict risk for, either cash flow or earnings. Additionally, in more complex situations, you would determine all of the factors that affect your risk measurement. Common effects on cash flow include operation expenses, investment income and expenses, and financing income and expenses. Common effects on earnings include variability in stocks, bonds, interest, and income. The second step to calculating cash flow or earnings at risk is to perform forecasting or exposure mapping based on current or historical data. The third step to assessing cash flow and earnings at risk is to run a scenario of the possible fluctuations to cash flow or earnings. There are many different ways to compile or calculate the different scenarios. Possible ways to generate multiple scenarios is listed on the slide. Once you have compiled a statistically acceptable amount of scenario data points, you can perform the fourth step, which is to evaluate the scenario simulation by graphing the data. From this graph, you can then calculate your value of cash flow or earnings at a predetermined confidence level. Finally, once you have established your risk value at a specified confidence level, you can determine what your cash flow or earnings at risk will be based on your targeted value. Next, we will walk through an example following these 5 steps to calculate earnings at risk for a company named Memo Inc. Memo Inc. elects to calculate earnings at risk due to fluctuation in gold prices. Therefore, measure maximum potential shortfall relative to a 95% confidence over a 12-month period. For the first step of identifying all of the earning values and factors, we have identified we are calculating earnings at risk due to fluctuations in gold prices. We have also determined the time period will be a year, and we will use a confidence level of 95%. Next, in this example, we perform exposure mapping to determine amount of gold per troy ounce that will be purchased in the year to come. The table below shows the expected amount of gold to be purchased based on the previous years. Using the table on the last slide, we can determine an equation to be used for the scenario simulation in the next step. Here, we have determined an equation that will equate the total expense, G, for a given year. Now on to step 3. Here we have used vector error correction modeling, or VECM, to create a model of various changes to the price per troy ounce. The chart below shows various probability of price distributions, and from this 10,000 scenarios are generated. Once the 10,000 scenarios are generated, we will plot the results and analyze. Now we will compile the results of the 10,000 scenarios to create a normal distribution to calculate the 95% confidence level. For this example, the value of expenses at 95% confidence is $6.38 million. Now we compare the 95% confidence level of $6.38 million to the budgeted amount to determine the earnings at risk value. Memo Inc. budgeted the cost per troy ounce to be $300 per ounce. Therefore, over a year, the projected expense for gold would cost slightly less than $6 million. Based on the budgeted value and 95% confidence value, we can calculate an earnings at risk of $387,000, meaning there's a chance for Memo Inc. to lose $387,000 in the next year. In summary, here is a table comparing the risk measurement analysis tools and what they measure, including comments for each tool. These tools enable companies to measure risk associated with different assets, incomes, and expenditures. With the risk known, companies can make educated decisions about future and current financial strategies.
My name is Brian Binder, and my final project for IE590 Financial Engineering is on value investing. Value investing is the strategy of selecting stocks that trade for less than their intrinsic values. Value investors actively seek stocks of companies that they believe the market has undervalued. Benjamin Graham's definition of intrinsic value is the value which is justified by the facts. For example, the assets, earnings, dividends, definite prospects, as distinct from market quotations. The intrinsic value can be estimated by using companies' annual reports and looking at their consolidated financial statements, which include balance sheets, income statements, and cash flow statements. My objectives for this project are first to provide a brief history and the basic tenets of value investing, and then use empirical evidence to prove that purchasing a stock at a high price to earnings ratio, also known as a PE ratio, can be detrimental to overall returns by examining the returns of 30 companies that make up the Dow Jones Industrial Average. Benjamin Graham is considered the father of value investing. Himself and David Dodd wrote the first edition of Security Analysis in 1934 in the midst of the Great Depression. Ben Graham also wrote The Intelligent Investor, and these books are considered probably the most prevalent in the realms of value investing. Although some of the stuff may be a bit outdated, most of what they've written in these books still rings true today. They also proposed the margin of safety, which is the idea of having basically safety of principal while receiving an adequate return on your principal for taking some amount of risk. Warren Buffett is also is a major value investor, probably considered the most successful investor in history. He is the chairman and CEO of Berkshire Hathaway, which is now worth almost $300 billion. The book value of Berkshire Hathaway has shown an annual compounded gain of 19.7% from 1965 to 2012, resulting in a total gain of 586,917%. As a comparison, the S&P 500, its total gain was 7,433% over the same period. I used 3 different data sources for this project, which include Edgar Online, Google Finance, and Yahoo Finance. Edgar Online is the Securities and Exchange Commission's website that you can access annual reports, quarterly reports, and other miscellaneous reports posted by public companies that trade on American stock exchanges. The annual reports are also called the 10K report. Quarterly reports are 10Q reports. I used Google Finance to get some company info on the Dow Jones Industrial Average components, and I also got the historical prices from Google Finance. Google Finance actually takes into account stock splits in their prices. Yahoo Finance does not take into account stock splits, so you have to adjust the data for that. But Yahoo Finance has a lot more data available that goes back further, which was helpful in this project. I made a number of assumptions and simplifications for this project. To start off with, the stock's value is calculated by finding the present value of all future returns at an appropriate discount rate. The second one is dividends are not taken into account. Returns are shown strictly based on stock price advances and declines. When a company earned negative returns for any year, I adjusted the price to earnings ratio to 0. The last and most important assumption that I made is that markets are not always efficient. Most of the time, and for most stocks, the markets are efficient. However, they're not always efficient. This is where a value investor must take advantage of the market. The methodology I'm using for this project is to use the net income per year for each of the 30 stocks that compose the Dow Jones Industrial Average from 1991 to 2012. I also used the price of the stock adjusted for stock splits approximately 3 months after the end of each fiscal year. This is when the annual reports or 10Ks are typically made available to investors. I use the average common shares outstanding, diluted if available, to find net income per common share. The next thing I have to do is solve for the price to earnings ratios for each year at the approximate date the 10K reports are released. This represents a purchase of the stock each year at the current price and price to earnings ratio. I then solve for the compounded annual return based on the market price from each year to the market price at the 2012 annual report date, the last submitted 10K. Here's an example of how I performed the analysis of each stock in the Dow Jones Industrial Average. Microsoft is one of the 30 companies that's in that average. In 1995, Microsoft was trading at $5.61. That price is adjusted for stock splits. This price of $5.61 would be considered the purchase price in 1995. 2012, the price was $30.38, which results in an annual compounded gain of 10.45%. The 1995 price to earnings ratio was equal to 36.32. In contrast, in 1999, Microsoft was trading at $46.19, which would also be considered the purchase price in that year. Again, in 2012, it was trading for $30.38, resulting in an annual compounded loss of 3.17% per year. The 1999 price to earnings ratio was 65.05. Here's an example of how I evaluated each of the 30 companies that comprise the Dow Jones Industrial Average. This example is Johnson & Johnson, stock symbol JNJ. The spreadsheet on the left side of the slide shows years from 1991 to 2012 with the PE ratios and the annually compounded return to present. I calculate the annual compounded return to present by taking the price in each individual year compounded to the price in 2012. If you look at the graph on the right side of the slide, you'll see the blue line is for the price to earnings ratio. This shows the price to earnings ratio kind of varying as time goes on, and you'll see in 1998 they were trading at a very high price to earnings ratio of about 42.5. At this point, they were returning one of the lower compounded gains based on trading at that higher price to earnings ratio. Around that 1998 time was right about when we were in the boom, and then subsequently we had the bust in the early 2000s, and you can see the price to earnings ratio starts to come down there. In 2008, you can sort of see the same thing where the price to earnings ratio drops down to just over 10, and you can see there that the annual compounded return to present increases up over 10%. An example here would be in 1993, you've got a price to earnings ratio of 14.73 with a lower P ratio like that compared to the other price to earnings ratios that you see. You'll notice that the annual compounded return to present is a little bit higher than all the rest at 11.26%. Here are the results to all the data that I've come up with through this project. This is the 30 components of the Dow Jones Industrial Average, showing the compounded returns, the average compounded returns, when the stock is trading at a price to earnings ratio in a different group. The first group I've listed is a price to earnings ratio above 30. The second is a price to earnings ratio above 20 but below 30. And the third is a price to earnings ratio below 20 but above 10. The last one is a price to earnings ratio below 10. If we take an example, such as the first one, stock symbol AA, which is Alcoa, and you say in four different years, Alcoa was trading at a price to earnings ratio above 30. In that case, I took the average of all those of the compounded annual returns when it was trading above 30 and came up with negative 12.97%. I did this for all the groupings, all four groupings of each stock, and came up with an average when stocks in the Dow Jones Industrial Average trade above a price to earnings ratio of 30, the compounded annual return averages 3.66%. When the stock is trading between 20 and 30, at a price to earnings ratio between 20 and 30, the compounded annual return is 4.26%. When the stock is trading at a price to earnings ratio between 10 and 20, the compounded annual return is 7.05%. And when the stock is trading below a price to earnings ratio of 10, the average compounded annual return is 12.23%. So this shows that as the price to earnings ratio decreases, the average returns compounded annually start to increase. The conclusions for this project are that a stock purchased at a high price to earnings ratio will on average produce lower returns over time than a stock purchased at a low price to earnings ratio. This, however, does not hold true for all stocks, but is representative of the average. A policy of purchasing stocks with a low price to earnings ratio does not guarantee adequate returns. It should, however, on the average, produce an adequate overall return and a better return than purchasing stocks with a high price to earnings ratio. This will require a contrarian attitude when purchasing stocks, because stocks with low price to earnings ratio are typically out of favor with most investors. Some possible future work that could be done with this project would be to look at rolling returns over 5-year periods. This would take out some fluctuations in the graphs, such as the one I showed you about Johnson & Johnson earlier in the presentation. This would just be averaging the previous 5 years' earnings to reduce any variability. The next one is to include dividends in the returns. I did not include dividends. The amount of data that I acquired in doing this presentation was quite large already. Adding the dividends would just increase that, and being the only person working on this project, I decided to leave dividends out. However, this would be something good for future work. The last one would be to dive deeper into stocks that show a stable and adequate earnings record to find if they are suitable for investment. Ben Graham and David Dodd outlined some other things, which would be satisfactory backing of tangible assets, looking at balance sheets, looking at cash flow statements, and seeing if a stock meets the requirements for investment to be a suitable investment, and also comparing the actual price, the current price, to what you think the stock is worth, and seeing if you have enough margin of safety in order to purchase the stock. Thank you very much for listening to my presentation. If you have any questions, please feel free to contact me. My name is Brian Binder, and my email address is bab385.
Hello and good morning. My name is Raj Singh, and I, with Brian Cruz, are going to take you today through the seasonal and January effects on the stock market. I'll be going through in detail for the seasonal effects and explaining the six major seasonal effects that are observed in the stock market. And Ryan will be taking you through the January effect, which is a very well known formula in today's market, and will also be concluding these presentations. Uh, Let me first go into the efficient market hypothesis. Eugene Farmer is known as the father of the efficient market hypothesis. He defined market as a market in which prices always fully reflect the available information. What this means is that a stock will always follow a random path, and it will have random highs and lows, and it's impossible to predict the future trading of a particular stock based on the publicly available information. Seasonal effects can be defined as a characteristic of time series in which the data experience regular and predictable changes that occur every calendar year. Now, this is different from a cyclic effect where there is a period of there's a period of years where you can see a cycle where there's a continuous high or a continuous low. But this seasonal effect is different from the cyclic effect in a way that it is contained within a year, within one calendar year. Now, the major seasonal effects are the monthly seasonality, the end of the December effect, turn of the month effect, window dressing, pre-holiday rally, and day of the week effect. Monthly seasonality shows how the different months in a calendar year show what kind of trends do they show. So it is seen that months tend to show the same trends, high and low, on an average every year. And what we need to understand here, and what is important to understand here, is that it is an average and not a rule, because there will be always be exceptions to these averages. The graph below shows the 5, 10, and 15-year seasonal study that was done on the S&P 500. Now, as you can see, the lines are show a little bit of a trend on how these market perform. The green one is the 15-year average, the red one is the 10-year, and the blue one is the 5-year average. Uh, Now, the common trends that can be taken from the above graph are we can clearly see that the market lowers in the first couple of months. I mean, after the January effect has died down, we see the market lowers for the first couple of months. Then there's a bullish time and we hit a big high in mid of May. This high generally weakens from the mid of May, and there is a short rally at the early June. So this leads to the popular adage which says "sell in May, go away." Uh, Beginning of June might be a short-term peak, and we see the market to be very bearish in mid-September and early mid-October. The market tends also to bottom in mid of November, and then there is a very big rally towards the end of the year. To summarize the monthly seasonality, we note the three most important points. The mid-March to mid-May period is generally a bullish time. The mid-September to mid-October is generally the weak time for the market, and then again we say that the mid-November to the end of the year, maybe the first couple of weeks in January, are a very bullish time in the market. Seasonal trends may also change over these years. Now these two graphs are from Dow Jones and they're from different time periods. So the first graph shows the monthly average returns from 1956 to 1982. In this graph we see that the peak was at uh, in the month of May, and in the second graph, which is a average from 1983 to 2010, we see that the average high is in July. So we see that the peak has now shifted from May to July. So these may change, but the fundamental process remains the same. The other thing that we should take into account here is how investors can capitalize on this effect. These seasonal patterns help investors aid their timing for purchase and exits from the market. But there's a need to understand the difference between market timing and how seasonality is factored into that. Market timing is just defined as a short-term period, and you time the market between its highs and lows. And seasonality is about anticipating how the market is going to change and taking a position before the market changes. So, as an example, if I know the market is going to be bullish between mid-November and the end of the year, I can buy more equities in September and take a good position on the market. The second effect is known as the end of the December effect, or also known as the Santa Claus rally effect. It's discovered by Mr. Yale in his Stock Trader's Almanac. This effect simply defines that the stock rallies at the end of the year and continues a little rally into the first 2 weeks of January. The main reasons that are being cited for this effect are the end of the tax loss selling, and that mutual funds and financial institutions seek to be fully invested for the new year. The other reasons may be cited, but that can be cited are that some good news may be released at the end of the year and to the good mood of the investors because of Christmas and New Year. The first shows on how the stock rallies at just the end of the year, and you can see on all the vertical lines, the stock really rallies into the end of the year. This is the turn of the month event. It shows and refers to the tendency of how a stock varies within a month. So the graph here is a very good explanation on how these stocks react in a particular month. It shows the average of Dow Jones from 1885 to 2001, where you can see that the first 3 days of the month, the last 2 days of the month are very high return days, and in the middle of the month it's very erratic and it's kind of a weak time for the market. So um, this can be related to the periodic new money flows by the mutual fund investors during the beginning of the month. So this effect is very powerful and very easy to use, because if you have a monthly cycle of making investments you can make a regular contribution during the middle of the month where the market is usually weak, rather than at the start and end of the month. This is the window dressing effect. It is generally triggered by the mutual fund managers who want to save their jobs because they want their balance sheets to look good. They try to invest in stocks that have been doing well in that quarter. This may affect the individual investors as transition costs may outweigh the benefits of these transactions. This is a very simple pre-rally effect where it is usually said that the market is bullish before the 3-day holidays that are being observed in the US, like the Independence Day and the Thanksgiving, because it is said because of the good mood of the investors. Who will be taking you through the January effects.
Thank you, Raj. Moving forward with the January effect, we will now look at two main hypotheses, both the tax loss selling hypotheses and the risk premium hypotheses. Now, the tax loss selling hypothesis was first proposed by Dill in 1977 and has been reinforced by several other research papers since. It simply states that stocks that incur negative returns during the previous year see high January returns. Reasons for this are likely before year-end, investors sell stocks in which they have losses to decrease their taxes on net capital gains. Selling pressures decrease prices at year-end while the prices rebound in January, leading to large January returns. And we see from the chart below that net buying pressure decreases and goes negative at the end of the year, and at the turn of the year in January, that buying pressure becomes positive. Looking at the charts on this slide, on the left we see the average monthly turnover for municipal bond funds, which is similar to other small cap stocks. We see years such as December 94, December 99 with very high turnover. And those were years where we saw large losses throughout the year. People did not sell until the end of the year. On the right hand side, Ranganum plotted the daily return for some of the smallest portfolios, and see that at the turn of the year, those early days of January, they had the highest returns, thus supporting the tax loss selling hypothesis. So in a general conclusion of that tax loss selling hypothesis, there's been a lot of support from Dill, Javali, and Ovadia, and Ranganum that shows that stocks with declining price tend to record abnormally high volume in December and abnormally high returns in January. Nevertheless, there are some challenges to this hypothesis, and Constantinides explained that the optimal tax trading strategy did not include delaying loss realization until December. In addition, the January effect has been noted in countries without capital taxes, and January effect has been noted prior to U.S. income taxes. Now, switching gears to the risk premium hypothesis, there was a paper written by Soon and Tong published in the Journal of Banking and Finance in 2010. The results of the study showed very strong evidence that indicate the risk premium is higher in January as opposed to risk itself. So their study simply stated that there is no clear evidence with the data they analyzed that risk is higher in the month of January, but they did note that higher compensation for risk appeared to drive for higher returns in January. The chart below illustrates that those small size portfolios in January would have higher returns if they had constant betas. Looking at the risk premium, the mathematical model that Soon and Tong used was the GARC, which is the Generalized Autoregressive Conditional Heteroscedastic Model. It is a very flexible model that can include various variables depending on the intent of the study. The model below includes a January term that would account for the abnormally high returns in that month. So digging deeper into Soon and Tong's study, they constructed 3 different GARC models to investigate various dependencies of the rate of return. The 3 things they looked at were the January effect itself, risk, and the risk premium. The 3 models are listed below. Each of these models has the following purpose. Model 1 would state that the January effect exists if alpha 2 is both significant and positive. It also would say that market risk is higher in the month of January if beta 2 is significant and positive. Model 2 would show that higher market risk is an explanation for the January effect if alpha 2 is insignificant and alpha 3 is both significant and positive. And lastly, Model 3 would show that the higher price of risk, or the risk premium, is an explanation for the January effect if alpha 2 is both insignificant and alpha 4 is both significant and positive. So looking at a summary of their results in the chart above, you'll see that the conclusion supports their hypothesis that the January effect exists and is related to the higher price of risk, or the risk premium, in the month of January. Again, nevertheless, there are some challenges. It still remains unclear as to why investors require higher premiums on risk for the month of January. Recently, however, it has been noted that the January effect has not been as prevalent. Some reasons behind this include the fact that investors are trying to take advantage of this phenomenon, and by doing so, this can diminish the January effect itself. It has also been noted that other trends or events can have a much larger impact than seasonal impacts, as noted recently with the fiscal cliff, would have a significantly larger impact than the January effect. In conclusion, we look at seasonal effects and see that there are many theories as to the cause of these market fluctuations, and knowing the general seasonal trends can be very beneficial to investors. Looking at the January effect, it is noted that it is a special case of a seasonal effect, and many studies have been completed investigating the January effect, but no true understanding of the phenomenon is very prevalent. In addition, if investors anticipate a January effect coming, the phenomenon is slightly diminished when that occurs. So again, thank you for your time. Seasonal January effect.